Great. So, ladies and gentlemen, good afternoon. I'm here to talk about the SACCO Societies Amendment Bill 2025. I've seen so many people crying about this bill. Is it really that bad? So this, of course, is the biggest reform in Kenya's SACCO sector since the creation of SASRA. And it is what exactly every CEO, director, manager, and supervisory committee member of any SACCO needs to know. Why does this bill matter? Kenya has approximately 13,000 SACCOs with over 7.4 million members. A whooping Kenya shillings 1.1 trillion in terms of investment in assets by SACCOs, Kenya shillings 850 billion in deposits, Kenya shillings 750 billion in terms of loans issued. The SACCO sector is no longer a small cooperative movement. It is a major pillar of Kenya's financial system. For those of you who have never met me, my name is Dr. Joshua Aura, Principal of RCM College, Management Partner at Aura & Company. Why are these reforms necessary? Because of recent events which have exposed serious weaknesses. The Cusco crisis, we saw governance failures, fraud allegations, weak oversight, members lost immensely, public loss of confidence in the SACCO movement. Then the question became, how do we protect SACCO members' resources better? The shocking discovery. This is very important for everybody to really follow. Out of approximately 13,000 SACCOs that we have today, only 355 are directly regulated. More than 12,000 are operating outside the full regulatory framework. That is quite sad. The Reform Committee concluded that it's very important for every member to get equal protection. That means that all the SACCOs should be brought into regulatory framework. Under this bill, what are the 10 big reforms? I'm only looking at the 10 big reforms. Regulation of all SACCOs. A stronger SASRA in terms of powers. It's recommending a central liquidity facility, a deposit guarantee fund, a stabilization fund, CEO and the directors vetting, restrictions on borrowing for dividends, shared services framework, SACCO consolidation, the smaller SACCOs of course have to merge, transition from SACCOs towards credit unions. So I'll go through each one of those items one at a time. Most importantly, please get to understand, all SACCOs to be regulated. The era of selective regulation is coming to an end. The proposed framework seeks to bring all SACCOs under a harmonized regulatory environment. Implications: greater member protection, greater transparency, improved confidence, reduced governance loopholes. So let's bring all these SACCOs into regulation. SASRA will be getting more powers if this bill is enacted. The reform seeks to strengthen SASRA's capacity and authority. To be very specific, the areas we are looking at: number one, governance oversight. Number two, risk-based supervision. Liquidity supervision, just like our central bank supervises liquidity of banks, SASRA now will be having a liquidity supervision. Capital adequacy monitoring, enforcement powers, they will be able to do what we call early warnings. The regulator will become more proactive than reactive. The rise of the secondary SACCO. Now we shall be talking of primary SACCOs and secondary SACCOs. The bill introduces a completely new institution known as a secondary SACCO, a SACCO that serves other SACCOs. It will become the vehicle for central liquidity, where these SACCOs here come together, they pool their liquidity together through these secondary SACCOs. Secondary SACCOs will be able to provide shared services, shared technology, shared payment systems, a sector-wide collaboration. SACCOs will no longer be competitors. They shall collaborate. Very, very important for us to understand this concept of secondary SACCOs. The new ecosystem. Today, what do we have? We have members dealing directly with their SACCOs. If this bill becomes an act tomorrow, then we shall have a member who deals with their primary SACCO, and then the primary SACCO will also be dealing with another higher SACCO at a higher level called secondary SACCOs. The future will be cooperation among SACCOs themselves. Another great proposal is the central liquidity facility. This may become the most transformational proposal. Instead of rushing to commercial banks to borrow, SACCOs with excess funds support SACCOs with temporary shortages, similar to how commercial banks access liquidity support. The benefits of this, of course, if it is SACCO to SACCO, then we shall be able to have lower funding costs, better liquidity management, greater sector stability. All right, because at times you go to a bank as a SACCO to borrow, they want collateral, so they tell you, no, we're not giving you this loan. If it's SACCO to SACCO, it'll be very easy for ourselves to understand each other. The end of expensive banking borrowing. Many SACCOs today borrow from commercial banks. Some borrow at 18%, and then they get to lend to their members at 12%. The result? Most of them make losses. And because they have a strong pressure from their members to declare dividends, they will declare dividends with losses, and then they keep on borrowing to even finance those dividends. The reform seeks to create cheaper internal sector funding. Because, ladies and gentlemen, under these proposals, we shall not be borrowing to pay dividends. One of the strongest governance messages in the reforms is that we shall not be having SACCOs borrowing from banks to pay dividends. Some institutions have borrowed money simply to maintain attractive dividends because directors want to be reappointed. When you borrow to pay dividends, you are creating artificial profitability. You will be at a weaker liquidity position. You will be misleading. You'll be having misleading financial signals. And then in the future, what will happen? A crisis, future financial stress. The new philosophy is simple. Dividends must come from genuine performance, not from debt. This is something that I really love out of these proposals, that now SASRA is being given an opportunity to vet all CEOs. The banking sector has long required vetting of senior executives by the central bank. The SACCO sector is moving in the same direction. Before appointment, CEOs now will be subjected to qualification assessments, experience review, integrity assessment, professional competence evaluation. This automatically will raise leadership standards. You can't mess one SACCO here and then you're taken as a CEO of another SACCO. That is coming to an end. SASRA will also have an opportunity of vetting directors. Being elected may no longer be enough. You'll be elected by members, but SASRA can say no. Directors will also need to satisfy fit and proper requirements. Future boards must demonstrate integrity. Competence. You can't be a director of a SACCO without financial literacy skills. Governance capability. The era of ceremonial directorships will end with the old act. Again, this is very, very important. At times we have had situations where good CEOs are being removed from the office unceremoniously because simply they have parted ways with directors. CEO removals now will face scrutiny. The reforms seek to prevent situations where competent CEOs are removed for enforcing discipline within SACCOs. SASRA may have now greater involvement in leadership transitions. The goal is to protect governance from politics. Now we have a deposit guarantee fund which will come once this bill becomes an act, which will lead to member confidence, which basically depends on protection. The proposal seeks to increase protection from Kenya shillings 100,000 to Kenya shillings 500,000, bringing SACCO protection closer to banking sector standards. You see, if for example a bank collapses today, mostly the members' funds are protected up to 500,000. They are also introducing a very, very great proposal of stabilization fund being created, which is a rescue mechanism for temporary distress. The purpose will be to support viable SACCOs, prevent collapses, because whenever there is a temporary financial distress, members would go for their money. So to avoid SACCO overrun, we need this stabilization fund. So to prevent collapses, maintain confidence, we need it. Avoid unnecessary failures. This is sector self-insurance. Then we have, of course, new SACCO registration rules. Currently, if we come together as just 10 members, we qualify to create a SACCO. The new law is proposing, minimum of 1,000 members are needed to create a SACCO. Minimum of Kenya shillings 10 million capital base. Member-generated capital. You can't be running to these politicians here to give you money, and then you say that now you have a SACCO. No, you want the capital to be generated by members. Reduced dependence on those Harambes. The objective is stronger institutions from day one. These small SACCOs are already in existence, which have less than 1,000. There is a strong proposal for them to merge and consolidate the operations. About 13,000 SACCOs may not be sustainable today. So their future is they are being encouraged to merge, consolidate, shared services like the infrastructure, right? And if that happens, then we shall be able to have fewer SACCOs, which will be large institutions with stronger balance sheets, statement of financial positions. Bigger, of course, is safer. This is quite interesting. From using SACCOs to what we call credit unions globally. Cooperative financial institutions increasingly operate as credit unions. Now Kenya is coming up of age and smelling the coffee, and we are gradually aligning with this model. We should be talking of credit unions. The objective will be we want to rise to international standards. We want global recognition. Modern governance, enhanced competitiveness. We don't want to be dealing with small SACCOs that people fear. No, we want giant. Already as we speak, by the way, there are some SACCOs which are bigger than some of the listed banks here. All right? So when you talk of shared services, why should every SACCO build everything alone? Some of these SACCO systems are very, very expensive. We would rather have one expensive one, but now shared by many SACCOs. The future possibilities under here is the shared core banking system, shared digital banking, shared payment systems, shared innovation platforms, shared technology infrastructure, which will of course lead to lower costs to SACCO and of course impact on our efficiency. We expect greater efficiencies in SACCOs at a very tiny fraction of cost. digital transformation. Ladies and gentlemen, today, most SACCO members would want to work with their SACCOs in their pockets, in their telephones. So members now expect mobile banking, USSD banking, WhatsApp banking, instant loans, real-time services. Most importantly, they want what we call self-service channels. Members would want to be serving themselves when they get access to their SACCOs. So the future SACCO has to be digital. The future of Kenya's SACCO movement has already begun. I know there are so many people who are against this bill, but how I wish people can come together, and then at the end of the day, we need to look at even ourselves. We have amendments that we would want to talk to the government about. There are other proposals there which are very, very good, but of course there are some other proposals that may need some secondary, that may need some panel beating. You see, for example, like now this concept of secondary SACCO, if you ask me, it's quite vague. Do we need, like for example, 3 or 4 SACCOs coming together and then they form a secondary SACCO? Or do we need one big secondary SACCO for all the primary SACCOs? That is something that we need to tie in to be able to get something robust. All right? And then most importantly, ladies and gentlemen, I would want to take this opportunity to introduce a very high-end SACCO system done by a company known as TechVav. Aura and the company, we are their appointed resellers of this SACCO software known as SACCOVav. SACCOVav is a native SACCO system. You know, there are so many ERPs outside here that you will still need to so seriously work on, and bend them, have so many modules to be able to make them become SACCO systems. But SACCOVav is a natural SACCO system. If you're looking at FOSA, BOSA, you're looking at loans management, guarantors management, and so many other things of SACCO, including having dashboards, that every director can follow from wherever they are, because SACCOVav comes with mobile applications. It's really a digital system. It is able, ladies and gentlemen, in this case here, to look at all the regulatory reporting, capability of members, self-service. SACCOVav is what you need to consider. Any SACCO is not a trading company. When you have a typical ERP, these typical ERPs, most of them are designed for recognizing sales, profit companies, purchases, inventory, manufacturing, very good. For example, for inventory management, fixed assets. They are very, very good. But you see, SACCOs are supposed to be managing members. And the members have got feelings. They need most of their things to really, so long as they are in alignment, they need most of their things to be done quite fast. So in this case here, SACCO manages members. A SACCO is managing shares. It's managing deposits of these members. It's looking at the guarantors, dividends being paid, front office services, back office services. And if you really need everything then to fall onto one platform that will not need a lot of tweaking, then think about SACCOVav. Think about SACCOVav. With SACCOVav, which again comes at really reasonable prices, with lots of support, because Aura and company is based here in Nairobi at Westlands. Lots of support. Then automatically you will be able to get a system which you will give us a chance, regardless of the number of members that you have. There could be 50, there could be 10,000, there could be 100,000. Then a SACCOVav, we shall be able to deploy a system for your immediate usage, maximum 3-4 months, you are good to go. And then of course, because we are here with you, we shall ensure that you are well trained, so you can use about 90%, if not 100% of the system. I've audited SACCOs previously for many years, and I can assure you, there are SACCOs that have got great ERPs, but they're only using like 10, 20, 30%. Yeah, because training is lacking. Because, of course, most of those modules were just customized along the way. Yeah, otherwise, those systems are not meant for SACCOs. SACCO ladies and gentlemen, is basically a member's logic system. Once you give us an opportunity, we shall be able to demonstrate to you. Otherwise, to reach out to us, our number is 0769 111 000. You can come to our offices, Aura and Company, yeah, based at along Wayaki Way in Westlands, yeah, Havens Court, and we shall be able to show you how this great system works. Otherwise, we wish you well as SACCOs as you navigate through this bill. Yeah, before it becomes an act, we can only wish you the very best. Thank you so much, and bye-bye.